Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. I'm going to be going over the datasets and the SPY for June 6th, 2025. Why did I say June 6th? June 4th, 2025. And with that said, let's go ahead and jump straight into the data. If it will pull up. There we go. Alright, so I actually want to circle back to Monday's data because there is a very huge data print on here that I think majority of the market missed, including myself, because I just wasn't paying attention to it until later today. But it's the Atlanta Fed GDP. Now, the GDP now is the current GDP. It is the most accurate from anything being reported, at least from like, any of the government report let me cycle back. Government reporting agencies. So it's quote unquote technically the most accurate GDP reporting. Um, so that's a huge deal. This is saying that essentially we're having the best economy the United States has almost ever had. Um, that's bold. I don't know how I feel about that, but it is raising the treasury yields. Um, it will very likely be increasing the weight of the dollar, but this will also help pump the market, I believe. And the reason why is because it's going to slightly alleviate the recession scenario, and I shouldn't say scenario, the recession thesis anyway. Um, and that drives a lot of the rate cuts down. It drives a lot of the fear and uncertainty away from the economy. Not so much the market, but from the economy. And just quickly describing yields because I know many don't really understand how they work and treasury yields are very complicated. There's a lot that goes behind them, but for the most part you can think of yields like this. So yields constrict credit. It means that whenever the yields go up, it reduces the amount that banks can lend. And not exactly how much they can amount or how much they can lend, but it constricts the dollar. It constricts the just credit spending in general. It constricts uh, loans being written. It constricts just mortgage rates going up. So everything goes up. And when yields go up, generally yields go up on, I want to say bearish news, but that's not always true. It's more so hawkish news. Um, but generally hawkish and bearish news will go hand in hand. So it confuses people when we get a hotter data set that technically is somewhat bearish because it is raising the yields, it is raising the dollar, but yet we're seeing the market pump from it. Why does that happen? Well, when treasury yields go up, and you have to think about money for a second, um, just go back to what buying a treasury is. Out of any financial instrument you can purchase, and I'm not going to go into conspiracy theory or anything else, but just in economics, the most safe economic instrument you could purchase is a United States Treasury. It is, by far above and beyond one of the most safe instruments you can buy because it requires the United States to default for you to not get paid, which good luck with that. We're not going to allow our country to default. Are you kidding me? Never going to happen. So, that's pretty much a 100% for sure. You're going to get whatever percentage yield you put into that out of it. Uh, for treasury investors, this is a great time to start buying yields because you can get a lot of free money essentially. So what does that mean? When a treasury is giving more free money, it means that the risky financial instruments out there, so equities, speculative instruments like options, crypto, etc., etc., whatever you want to fill in the gap with. But those instruments have to pull more weight because why would people invest in risky uh, financial instruments if I can just go buy a higher percentage treasury yield that is, going to be 100% safe for sure bet. Well, the reason why is because risk generally provides somewhat more of a lucrative return. The S&P is generally providing a 12 to 13%, year over year. So, uh, most hedge funds are, attempting to beat the S&P in some form or fashion, or trying to hedge against something. There's a goal, but generally they are trying to beat the S&P. So what does that mean? Big money is going to be pushing prices upward, and that big money is going to be pushing prices upward. That's just how it works. Um, so other instruments, other stuff, so housing, um, you know, cars, anything is going up in value. People are having to pay more for their whatever they're trying to buy. But from the seller's perspective, you're getting more from, what you sell as well. So that's kind of how that works with the stock market. Uh, don't get super bearish when the yields start climbing because, that creates conditions to pump the market. So, yeah, enough about treasuries. We had the JOLTS job openings today, and that was super, super high compared to the forecast. Even the previous amount compared to the previous amount, that's a whole 190 million above. Or no, excuse me, 1.9 million. Um, but you understand what I'm saying. That's still a huge amount of people. That's 190,000 jobs additional. Quite a lot. Um, if I'm reading that correctly, I don't think that's 7 billion. So yeah, that's gonna be 7.391 million. Yeah, that'll be 391,000. Yeah, I just wanted to make sure I'm reading that right. I don't want to be reading this wrong, and my eyes don't always work correctly, so sorry about that. But yeah, um, a whole 190,000 job difference, though. That is a very, very significant amount, especially when the narrative has really been over the last year and a half that the job market is weakening, um, consumers are spending less, just tightening and constriction of the market and the economy. And that's not what we're seeing now. We're seeing reports that are coming out saying that essentially no, the economy is moving back upward. We're actually gaining strength right now, which that's surprising to me, but that's kind of what we have to roll with right now. And even just going over the data we have tomorrow, we have a lot of our non-manufacturing PMI data, and we also have, let's see, the NFP unemployment change from May. You see, they're expecting a large increase in the NFPs. So come Friday, very likely we're going to be seeing a large increase in the NFP report. Um, the PMI is expecting to come in larger. So, that's saying that producers and managers are increasing prices. Uh, that's a massive deal. Um, Very likely we do get slightly cooler numbers than this, but don't be surprised if we see the PMI coming in at 5.3 or even higher. I wouldn't be surprised by that at all right now. The market is really, or the all these economic data sets are really telling us that there is strength, and we might all disagree with it. I know that the treasury market really disagrees with it because the yields would be absolutely soaring right now, and they're really not soaring. They're just slightly going upward. Um, so the treasury market isn't fully set on this data yet. Now, We do have the beige book tomorrow, which for me, again, I've mentioned this many, many times that the beige book is the most important data set for me because this kind of tells you exactly what's going on with the economy. It's a 40 something page plus report, but there's generally a summary in the beginning or some sort of synopsis in the beginning. And if you want to read the whole report and you don't want to read the whole report, copy and paste it and put it into a AI. It doesn't cost anything, and it'll give you a very accurate understanding of what each Fed sector is really seeing on the ground from their businesses. That's a mouthful. Anyway, so tomorrow's an important day, but it may not move the market a whole ton. We're kind of in a weird period. Kind of, what I was saying earlier is how some of this bearish data, like I'm telling you right now, the forecasted data is suggesting that it's going to come in hotter tomorrow and that the yields will pull upward. Uh, in a normal market, that would be a bearish day for the market. You know, this forecasted data is saying that we're going to have a red day tomorrow. But because of just the whole economic repercussions of what this data is actually telling us that we're not going into some crazy recession, it could be causing the market to actually pick back up again in ways that we weren't really expecting. So yeah, that's enough about the data. Let's go ahead and get into the charts. Just a quick reminder before we get into the technical analysis. If you've been finding value in my insights, consider joining my Patreon. For just $12.99 a month, you'll get access to my trades, courses, and powerful tools to help you grow as a trader. I'd love to have you be a part of our team and community. And it's less than 43 cents a day. So if you'd like to join, click in the link in the description. Thanks. And as always, going over the daily chart, let's turn on our moving averages and our Bollinger Bands so that we can quickly go over the moving averages and Bollinger Bands. Okay, so the market closed at 596.09. The overnight is barely down right now. It's at 595.68, so only down 30 something cents. No big deal at all. Uh, the 5 month is currently at 591.19. And because the market closed rather high, it didn't close as high as I expected, but it closed high. It closed again at that 596.09. So we're very likely going to be seeing the 5 mile pulling above the 593 range. Very likely in the 593.40 range, give or take, depending on where the overnight in the pre-market open up, right? Now, we do have a very bullish move in the moving averages, and I'm going to zoom in a little bit just to show this, but I talked about this in last night's video, how today we were likely going to see the 5 mile crossing above the 10 mile again. Well, with this close, we have now created a much larger gap away from that 10 mile range. That's very bullish, because the moving averages are now set up exactly to push. And what that means is the 5 mile is above the 10 mile is above the 20 mile, and the 20 mile is at least above the long range or the long duration moving averages like the 200 mile and the 50 mile. So we are set to push. I know many are bearish right now, and I apologize for that sentiment. Uh, you really need to just turn off your RSI indicator right now, and I'll describe that in a couple seconds here. But let's just quickly go over the moving averages. Now, the 10 mile is at 588.50, so that's very likely going to be pulling up to the 589, maybe even the 590 on open tomorrow, depending again where the overnight and the pre-market opens. Now the 20 mile is at the 583.57, so again that is pulling upwards towards that 584, 585 range. We still won't see the 585 for a whole nother, probably another session or two, but again it is starting to, really clear a lot of support above us. or below us, I mean. Now, the upper Bollinger is at 607.15, and I talked about this in, the videos throughout this week, but as we start pushing up and as we really start climbing towards this upper Bollinger, this sucker is really going to start opening up. So if this is the target for the market right now, which from my personal opinion, from my experience, and just from everything I'm seeing right now, I am heavily suggesting that the market is going to be pushing for that level. It will be pushing much higher than what it is right now. So while the upper Bollinger is at 607.15 right now, it's very likely going to be around that 609, 610, maybe even 611 range by the time we actually reach this level. So that will be opening up quite a bit. The move upward is still a whole $15 above us, so we still have a little room to work on here. And that can lead to a support test in here. So let's kind of talk about that. We tested the 5 mile over the last few sessions, and we've talked about that, how we went all the way through the bottom of the 5 mile, all the way to the top of it. It was a very, very solid 5 mile test. Now, from that 5 mile test, we have had today where we have just entirely rejected the 5 mile. And when I'm saying rejecting here, that means we are bouncing upward from the 5 mile. So the 5 mile is underneath us. And if you remember, my analogy for the 5 mile is to kind of think of it as like a magnet. Either it's going to attract the market towards that price or it's going to repel the market. So currently it is underneath us, repelling the market away from us, which means, or away from it. So that means it's pushing the market upward. Um, that's exactly what we see in every single major bull push. And let's just go ahead and quickly look over that. I want to kind of open it up here. As you can see, even though we do have 5 mile retests in here, which, I've described this many, many times before, it doesn't matter how bullish you are, you will come down and retest support. That's just how the market works. That's part of the cycle. So as you can see in this major rally from 2023, 2024, the 5 mile has been underneath the market price for the vast majority of the rally in here. So, um, you want to see that as a bull. You want to see the market using the 5 mile as, a force to repel, to push us upward. Okay. Um, so far, that is what we are seeing, at least from the last 3 sessions. Now, that can change, and the reason why that can change is because the upper bounds of the 5 mile continue to open as we continually have the 5 mile climb up and up and up. So, assuming the 5 mile has the level at the 593, like I mentioned, then we can anticipate the upper bounds of the 5 mile being around that 595 range, 596, which means that technically, the market is currently trading in that range. So that's kind of how it happened with last night's session. It pulled right above that upper bounds of the 5 mile range and then slingshot. Um, I'm really anticipating that kind of happening in here too, just because that's how these pushes work. It comes down to the upper bounds of the 5 mile, trades in that area a little bit, and then it takes off when it has the liquidity. Now, again, you have to be careful with the 5 mile because if the market gets any sort of bad news, and again, we are in a very narrative driven market, so we can get, absurd news dropping any moment of any day. And we've seen that over the last few months. We all know that very well. Excuse me, I'm losing my voice here. Now, with that said, because we are hovering at the top of the upper bounds of the 5 mile range, that does mean that the 5 mile can be fully retested again. So if that upper bounds is at 595, that means the lower bounds is at 591. What does that mean? That means you can elevator all the way from 595 straight down to 591, down into that 590 range, and bounce right back up and fully retest support. Um, am I saying that's how it's going to work every time? Absolutely not. That's not how the 5 mod test works every time, but it can. So it's something to be prepared for. And again, you just hedge a few puts. I know many of us cut a large portion of our puts today, but you should have some of the long duration ones still. If not, then literally on open tomorrow, your job is to go get a couple long duration puts just to hedge these calls. And again, allow for the market to either retest that 5 mod or bounce off of it, and we continue our journey up to the upper Bollinger. Now, let's go over structure really quick here, because I don't want to make this video too long. Okay, let's see what we got going on. Alright, so from my illustration last night, and I'm going to pull up the 4-hour chart. You can follow along on the hourly. Again, the 4-hour chart just looks a lot better on my monitor, but you should be following along on the hourly chart. This is kind of what we were expecting here yesterday, is that we saw that potential head and shoulders right here. We highlighted it, and from the bottom of that head and shoulders, we talked about that inverse head and shoulders, and that this potentially can start pulling upward and forming a cup. Well, that did happen. Okay, it's not fully formed yet, and I really just need to highlight that there is still a whole $2 range right here that did not get filled. So no, this is not fully done yet. We do need to see that range taken and slightly above it for this to fully be filled out as the cup. But the cup is there. It is very close to filling out. It is wanting to fill out. Very likely it will fill out. And from that cup generally comes a handle. This is the time to hedge puts, because if the market wants to use this as like a triple top or double top, um, or some larger head and shoulders, larger inverse cup, then you're going to be nailing puts right at the top of this thing. If not, then you're hedging your calls for the larger move up to the upper Bollinger. So that's that. I'm going to turn off some of the drawings for a moment just because I don't want them cluttering the screen. Um, but we did break out of this bear structure right here. And how do I describe this? What this what this broke out from was really important, because this candle right in here essentially 5 mod test, 5 mod test, 5 mod test, breakout. It's now pushing away from us. It's pushing the market away from us. So to me, this is a very bullish market. Um, we absolutely should be seeing that 598 filled very, very soon here. I'm really anticipating it tomorrow. I'd be very surprised if we don't see it filled tomorrow. And from that, again, we should expect a small handle. And then realistically, you need to be looking to the all-time highs again, because that's exactly where this larger structure goes. If we don't have some major rejection here, then this yellow bullish cup and handle will fill out and will push us upward to fill that larger cup to the all-time high. If not, if we do start breaking down here, then again, we are still within the larger bear structure. We still can pull down, test support, and then if the market decides that, yeah, the market prices are just too high right now, we do need to sell off, then it can complete this inverse cup down here and work on going lower. But for now, I would be absolutely looking upward. Um, Again, I'm really looking to all-time highs very, very soon here. Uh, for now, my target's at 609 range, but that's going to be entirely depending on where the upper Bollinger strikes. Um, we won't hit the upper Bollinger tomorrow. I can almost guarantee that that won't happen. Tomorrow's very likely going to be a chop day to build the handle out on this smaller cup right there. Um, or at least finish the top and then start pulling down to build a handle. What you're really looking for from this handle, or from the top of this cup, is a bearish structure right here in that range to suggest that it is going to pull down and make a handle. And during the formation of that handle while it's pulling downward, you're going to start looking for bullish structure to suggest that it is going to head upward. Okay, I think we got it all. We'll just go over everything really quick. The ADL, again, this is the money flow. It's still having money just absolutely pouring into it right now. And I think the market narrative really does support, pushing pretty far above all-time highs again. And just to look at the daily chart, and I'm actually going to delete this inverse cup here for a moment because it's not important this second. But I did want to show you all the major buying channel and the major selling channel. Okay, we're actually just going to delete this cup too for a moment. I want you all to really see this. Now, for my colorblind viewers, the blue channel is the one on my cursor right here, so it is going downward. Okay, it is those two channel lines right there. The bullish yellow channel is the one going upward. Okay, so it's those two lines right there. We are nearly breaking out of the top of this major selling channel. And what that suggests is that we're going to start heading straight up towards this upper buying channel top, which again that will take months, okay? That will take time. But do you all see where that is? That's in that 660 range, 670 range. Um, we absolutely could be seeing a SPY that's, pulling very close to the 680 range near October, December. That's not unreasonable at all. Seeing if we continue getting good data, if we continue having a narrative that supports the economy not absolutely dumping, if the yields do keep rising, it definitely creates a condition to where we can continue, this major pump. However, we are at the top of a major selling channel. This is the time to hedge. So again, if you don't have puts hedged, you need to hedge some. You need to open some volatility positions and just prepare for the just in case that we don't break through this channel and we do start heading down, then you will be positioned right at the top. So, okay. I think I covered everything. Sorry for being exhausted all the time, everyone. I'm really struggling with it. It's really been making a massive, massive impact. I can't even talk. Impact on my life. Um, so I hate to apologize about it all the time, but it's something I'm trying to work on. It's something that I haven't been dealing with forever. It's new to me, so hopefully we can all just kind of get through it together and, focus on the future because I want to be doing this for a long time. And I would, like y'all to join me for as long as you need me. So, with that said, I hope everyone has a fantastic trading day tomorrow. Have a good day, good night, good whatever time, and I will talk to you in tomorrow's video. Take care.